Needless to say, opportunities come. Opportunities may well arise in the future that we look to identify. But the core of what we're doing is we're trying to get to a point where we're covering our ongoing costs from ongoing cash sources.
Hello, you're watching Proactive. Joining me is EMV Capital CEO, Dr. Ilyan Ilyev. Ilyan, very good to speak with you. EMV Capital now manages over £100 million in assets with direct and indirect interests in over 70 portfolio companies. How has the business model evolved since the merger 5 years ago?
Stephen, thank you very much. So, yeah, I mean, as you flag, we had a bit of a celebration of something starting with the five recently. 5 years since Net Scientific acquired EMV Capital, a business which I started years ago, and since then we have gone we've grown tremendously. We've gone from 8 companies with 12 million assets under management to, as you mentioned, 100 million plus, and 70 companies. I mean, these things are never a straight line. You know, there have been changes during the journey. There were things we thought would work out, others haven't. But overall, what we have stayed focused on was the key strategic elements of being focused on both deep tech and life sciences, 2 areas of where we believe growth is going to come. This is where the world's going to change from new companies, new technologies, new IP. But also that is where my team's capabilities lie. A focus on capital efficient investment structures as we work with these companies. A focus on proactive investment approach, working closely with company management and where necessary to intervene through what eventually became the venture build practice. And last but not least, while staying true strategically, also being nimble and able to jump on opportunities when those arose. It's been quite a journey. COVID started and COVID ended during that period. But now we have, we believe, a strong platform that is ready to scale and ready to go to the next phase.
Well, cash on hand stood at £500,000 at the half year. How are you managing liquidity while continuing to syndicate new investments?
Well, going back again to the changes we started a few years back, you know, that has been a key element of our strategy to identify different routes of generating cash at group level while we wait or help those companies to grow and eventually exit. So through that, as you've seen from our results, we have covered a growing proportion of our core operating costs. The loss has now decreased to 0.3 million from 0.6 first half of last year. And we have opened up different channels of revenues. So we are an operating company. We generate cash continuously through our various areas of operation. And equally, we're looking at selective disposal secondaries as ways of supplementing our cash need. Needless to say, opportunities come. Opportunities may well arise in the future that we look to identify. But the core of what we're doing is we're trying to get to a point where we're covering our ongoing costs from ongoing cash sources.
I mean, looking at opportunities, could you explain the strategic rationale for acquiring Destiny Pharma's IP and clinical assets and how they fit into your portfolio?
Look, this has been a very exciting project, and it's kind of one that really kicked up a gear over the summer, which we tend to find summer or Christmas periods are good for deal making. So in terms of this particular company, we had been tracking it for a while. We very much respect what the team had done there, the successful phase 2 trial that they had done for the XF73 asset. Now, this is focused on a major global problem, the problem of antibiotic and antimicrobial resistance, something we've known we all know for quite a while, and it's potentially a really, really big problem for the healthcare system. Roughly 2 million people a year die from post-operation infections. And what we liked about Destiny is that, it not only had a reasonably successful phase 2 trial, but they had done a very focused analysis of if we do a phase 3 trial, exactly what it will be focused on, which are the types of operations we want to target for pre-treatment. So from our perspective, look, actually, in a strange way, there's a lot of similarities to what we did with deep tech recycling. And it's funny to compare a therapeutics company to a plastic waste recycling company. But from our perspective, this is how the model works. These are highly IP intensive companies in ways in which the current market cannot handle kind of a straight line capital intense approach. So you have to find different ways with our capital efficient approach to fund these businesses and get them to a success. So we spotted a good opportunity. We acquired it, I believe, at a good price, and we're now implementing a venture build program for the business. As a result, we have added £500,000 of direct fair value to the PLC balance sheet at nil cash, and I really mean nil cash. We have made certain level of fees, and we have secured another contract for our value creation services. It's a good template for our venture build practice on a go-forward basis, shows what we're capable of.
Markslet Capital recently achieved a 2.5 times return on an exit. What does this say about your approach to value creation across the portfolio?
I mean, essentially, if you will, we have two playbooks within the business. One is what I have described, the venture build program, and this is where we are deeply involved building out these companies and getting them to the point where they're independent, can attract third-party funding, and grow our capital position with that. The other playbook is what we are doing with the Markslet Capital practice, where we are co-investing from an early stage, minority stakes, alongside other credible investors, tracking those businesses, again, being proactive in managing those, but not directly running those businesses. And what we have done in recent, you mentioned the exit, but I also mentioned our co-investment into Exempla, a bioplastics company out of Cambridge in the middle of a 40 million round. What we are doing is we are integrating the deal flow we're getting from Cambridge with the rest of our investment practice, both increasing our impact in that region, but also diversifying the investment opportunities our investors have access to. The exit you mentioned is also a good example of our playbook. We don't wait all the way through to a trade sale or an IPO. Maybe sometimes that makes sense. But also we look to take money off the table when we get to a good enough return for our investors. It shows that we're able to take a life cycle approach to our investments, and we're able to take liquidity at different points of it.
Looking ahead, Ilian, what are the key milestones for your venture building program, and where do you see the strongest opportunities for capital returns?
Well, we love all our children, but there's now there is a group of companies that each of them is showing good traction. Wanda in particular has shown some really strong growth in their recurring revenues model. If you recall, they provide remote patient management services to the US. They're growing quite strongly in the US at the moment. That brings its own challenges, kind of managing growth, managing scale up. That certainly holds a lot of promise. We've talked about deep tech recycling in the past and the several project opportunities they have now, in particular in Scandinavia, where they're working up they're in advanced discussions on a potential plant. Vortex Biosciences itself has made significant progress in the validation of their approach in the CTC space. So each of the companies in the venture build portfolio has a lot of prospect. What is universal to them is that we have a significant direct stake at PLC level, so that a success in any one of those can lead to outsized returns for our investors.
Ilian, I hope you'll continue to keep us updated with your progress. Thank you very much for speaking with us today.
Thank you, Stephen.
That's Dr. Ilian Iliev, the CEO of EMV Capital.